morning, everyone, and welcome back to day 3 of the CE Sustainable Finance Summit. And today we focus on one of the sectors that's the backbone of the economy, and that's banking. Banking is quite a complicated subject matter for anyone who has worked in banking. You know that these are not easy and small institutions. These are complicated institutions. And when it comes to decarbonization and climate especially, we have made a lot of progress across the board in terms of understanding, building capacities, building tools. But we do face the issue that the real economy hasn't changed as much. So with large institutions that have legacy assets, etc., this is going to be a really big journey to undertake to figure out how to do the transition. But of course, we're also operating now in a different geopolitical and trade situation, and we have a new competitiveness compass by the Commission. So we also have some big changes coming, and none of us are fully sure of what they're going to look like. But today we actually have a very exciting person to welcome back to the summit. I believe that Munir first spoke at our summit maybe 2 years ago. And it was fantastic. He woke up the audience. People loved his presentation, his keynote speech. And every year it's the highlight of the banking day that we actually have him join in person and share some of his passion and his insights. As a very international traveler, he visits a lot of countries every year. And we are very delighted to welcome to the stage the CEO of Central Europe, Citi. Thank you, Munir, for being with us, and the stage is yours.
Great introduction, by the way. I've got to live up to my mark, I guess. So. Let me start off. So Linda, thank you so much. It's a delight to be here, and I think you guys do a wonderful job. So on behalf of Citi, thanks so much. And my colleagues as well, I think they've done a great job to put my presentation together, so thank you for doing that. So ladies and gentlemen, good morning, and welcome. I'm actually quite thrilled to be here because, I think this event is something that the way it's organized, the way it's streamed, the participation, the speakers are outstanding. So it's phenomenal, yeah? And it's a pleasure to be here in Prague, a city whose history has shown time and again that resilience is just a virtue. It's actually a way of life. And today we're living in very interesting times. And in banking, as Linda said, we're once again being asked not to look back in worry, but forward with clarity. And all of us obviously read a lot, listen a lot, and hopefully today we can I have 15 minutes to share my presentation. And if we have some bit more time, I have at the end a couple of nice catchphrases which have actually streamed the media in the past couple of months that I'll share with you. So before I begin, let me say a word about why Citi is uniquely positioned to speak about these trends. And this is not it's not an advertising plug at all. But I deeply believe, Citi is a preeminent bank. We're embedded in, close to 100 countries globally, in Asia, Africa, Latin America, Europe, obviously. So we have a vast coverage. And we're actually very vastly doing business in Central Europe. So the remit I cover is 16 markets in Central Europe. And we see capital flows in real time. We're trusted advisors to governments, to multinationals, to innovators, and to investors. So we see the whole gamut of the client stream. And we just don't observe the shifts. As a bank, we really try and help to shape them. And our vantage point gives us a deep sense of how policy, innovation, and capital interact, and then how opportunity emerges. So let me start with this. The global macro trends we are witnessing right now are not just disruptions. These are catalysts. And for Central Europe, these are tailwinds in disguise. We're living through an era where every architecture of global capital is being redrawn. I've been in banking for over 30 years, and I tell you, this time it's really happening. New centers of gravity are emerging. It's driven by velocity of wealth creation. The rich have become richer, the middle class have become rich, and we're seeing it regularly. And there's regulatory competitiveness, and there's a lot of strategic positioning taking place. Take, for example, the UAE, where actually a lot of people were in last week. This has attracted $23 billion of FDI in 2023. It's positioning itself as a financial hub between Asia, Africa, and Europe. And this is the Middle East. Look at Singapore. It's the home to the most family offices than ever before. It's become a global wealth pivot for Southeast Asia. Trade routes are being rewritten. We see that all the time. The rise of the India-Middle East economic corridor and the digital Silk Roads from China to Africa are redefining connectivity. The Regional Comprehensive Economic Partnership, the world's largest trade bloc, now binds together 30% of global GDP, and interestingly, the US is not part of that. At the same time, the institutions that once governed global trade, like the WTO, are coming under strain. And we can see that right now when we look at the tariff discussion. Dispute mechanisms are stalling, enforcement is fading, we are witnessing the rise of bilateral power, and we're seeing corridors, cross-border fintech ecosystems, and tech-driven economic diplomacy that operate beyond our traditional frameworks. This is it's not just a redistribution of economic weight. It's actually a transformation of how trust, power, opportunity are being negotiated in the 21st century. So trust, power are being renegotiated as we speak today. So today what I'd like to discuss is 4 kind of themes that showcases where opportunity lies. In banking, we're very much opportunistic, as you know. And so I'm going to share with you where we see the world in the sort of the months and quarters ahead. So before I start, let me just share with you a personal note. A few weeks back, I traveled a fair bit in the region. I was in Romania, and I met one of our young analysts team in Bucharest. And she said something that really struck me. This lady's just joined the bank, and we were talking just briefly on a coffee chat, and she said, she doesn't want to work in banking just for banking. She wants to build it differently. And she tells me, that mindset of curiosity is so important. She had the forward-looking thinking. She was purpose-driven, and it really excited me to be part of this region. You don't see that mindset in many parts of the world you go to. So this is no longer a place in Central Europe that asks, how do we catch up? It's becoming a region that asks, how do we actually leap ahead? And that's exactly what today's themes are going to be about. So my first theme is about global capital is on the move. So let's start with one of the clearest signals in today's economic landscape. Capital is moving, it's moving fast, and it's moving with purpose. In 2023, the United States was the strongest recipient of global FDI globally. It attracted more than $300 billion. But that isn't very significant. What's more significant is the US was also the largest outward investor of FDI of more than $400 billion. So inbound, but there's more outbound investment going on. So this is not a zero-sum game. It's a global realignment. The scale is massive. Global FDI stood at $1.4 trillion, and the US took nearly a quarter of that. It's an important number to keep in mind. And I'm not promoting the US in any way, but think about those numbers. They're mind-boggling. Europe accounted for 45% of US inbound FDI, reflecting the region's deep linkages to American innovation, talent, and scale. So Europe is a big player in the US. That's not just about capital. It's about strategy. So capital today follows clarity. It follows policy certainty, digital capacity, and human capital. The recent wave of structural tariffs we're witnessing every day today is an open invitation. What do I mean by that? Especially in the US, which is reshaping capital flows. Rather than deter investment, it has spurred companies to relocate, to rethink, and to re-anchor. This is not deglobalization. I stress, this is not deglobalization. It's recalibration, and where resilience is now the new return on equity. For Central Europe, again, open invitation for us. We must raise our hand as a region that offers predictability, engineering talent, access to the European single market, and global aspirations. So let me ask you for a second, just reflect. If you had $1 billion to deploy today across this region, where would you put it? $1 billion, where would you put it? What sector, what city, what theme? Because that's how global capital is thinking. And it's not thinking in decades. It's thinking quarter by quarter. So short-term vision is quite important here. And it's not thinking in borders, it's thinking in ecosystems. And the regions that win will be those that show both vision and velocity. My next point is reshoring, friendshoring, and Central Europe's opening. So one of the most important structural shifts in the past few years, especially post-COVID, has been how companies are thinking about their supply chains. We've read a lot about supply chains, but it's happening as we speak. The age of just-in-time is giving way to just-in-case. And companies are spending quite a bit of money already. McKinsey, recent article talks about global corporations plan to shift $1 trillion in supply chains by 2027, of which a third is already underway. So China plus one, we've heard of China plus one before, is not just longer a strategy, it's a necessity. And we can see Chinese capital around the world. From friendshoring, nearshoring to reshoring, this is now a new operating model of global trade. I was in China recently, and I tell you, the China today is not the China 5 years ago. And it's a wake-up call for us. Let's take a look at Central Europe and why we're uniquely positioned. We are within 1,000 kilometers from 300 million consumers. That's a huge consumer base. We are deeply integrated in the EU, and we have NATO security and a digital native workforce. If you look at the Rust Belt in the US, once upon a time, they were actually in industrial decline. Today, it's attracting billions in new manufacturing FDI. So why not the Danube corridor? Why not Krakow? Why not Brno? Why not Cluj? So we have assets here. What we need is ambition, to stop thinking like a corridor, but to start thinking like a destination. My third point is why Central European companies should look to the US. Let's try and flip the lens a bit. So why should Central Europe companies look towards investing in the US? And I'm not saying this because we're a US bank. I'm saying it with deep conviction. So let me give you 3 reasons. First, the US is the world's largest consumer market. It has, if you look at the GDP, it's $25 trillion in GDP, and it has more than 330 million consumers. If you're building global scale as a company, you need a US strategy. There's no question about it. Second, policy support is strong. The CHIPS Act, the IRA, and many more are driving investment. Over $200 billion has been announced towards clean energy projects, and in the past 2 years alone. So it's rapidly increasing. Third, the map is open. If you look at the US, Massachusetts and California are magnets for life sciences and tech. Texas and Georgia are booming in logistics and semiconductors. Florida and Arizona are building solar and EV infrastructure. So each state in the US is a microeconomy of tailored incentives and initiatives. So investing in the US is no longer optional. It's a hedge. It's a growth bet. And above all, it's a signal of global intent. We've just published an article on our global insights on investing in the US, and I highly encourage, it's a good read. My last point is about technology, energy, and AI advantage. We can't escape this. So we're living through a historic leap in innovation. We all know that. In 2024, over 50% of global venture capital in AI flowed into the US. That's more than what Europe and Asia had combined. But there's an opportunity. Central Europe is the fastest rising region in EU for AI patent filings. So that's impressive because of the great talent we have, particularly Czech, Poland, and Estonia. At the same time, energy dynamics are shifting as well. And obviously, a lot of the technology we talk about needs energy. Natural gas in the US remains 3 to 4 times cheaper than in Europe. And renewables now generate more than 23% of the US electricity. This is attracting heavy industry and into data centers. And this is a play we can make as well in Central Europe for data centers. The fourth industrial revolution is not about labor costs. It's about ecosystems, talent, cloud infrastructure, and regulation that promotes agility. Sustainability, digitization, and human capital, they aren't side issues. These are important lenses and investment filters people are using in the next decade. So technology, digitization, and human capital. And Central Europe, if you look at that, can compete if we act now, because we have clearly those bedrock of that. Mark Anderson, famous Mark Anderson, he recently put it, AI won't take your job, but a person using AI will. So that's the mindset shift in Central Europe. Our advantage won't come from trying to replicate what's in Silicon Valley. It will come from applying those tools in our context, in manufacturing, energy, mobility, and education. So in closing, from global shifts to local actions. So where does this leave us? So we are not passive observers, and I've seen this having lived in this region for more than 3 years. We observe global trends, and we are active participants. This is our moment to act, to position us as enablers of green transition, to build infrastructure, and to attract investments, and to lead, not by imitating others, but by unlocking our own distinct value, and we have that value. We must build ecosystems. I used the word ecosystem a few times. And we have to basically look at where capital, talent, and purpose all come together. And let's not forget, many of us in the room are actually parents. Our children are not waiting to inherit the future. They are building it. Our children are creating it. They are recreating it. Sometimes our children are disrupting the assumptions that we took for granted. And that's very important as we think about the next generations ahead. Because the future is not something we inherit. It's really something that we all build. Just imagine Central Europe in 2030. That's only 4 or 5 years away from now. In a region that isn't just a supplier to the West, but a center where advanced manufacturing, digital innovation, and sustainable finance is one we actually thrive on. So imagine a Hungarian startup that's exporting AI solutions to California. Very possible. Imagine a Czech-made battery powering a solar grid in Africa. Imagine a Slovak university creating a generation of quantum engineers. This is very, very feasible. It's in our sight. So this isn't idealism. It's direction. And the future isn't waiting to be granted. It's already being shaped by the bold. And you can see that day in, day out. In this region, it has engineering depth, digital native youth, a political will, and it's perfectly placed to lead. If you read the Draghi report, when you look at that, clearly sense of purpose. And this region actually embeds a lot of that in the Draghi report. But leadership is not claimed. It's earned. We all know that. And that starts by believing in the unique value we bring to the world. In Central Europe, we're ready, and let's just build it. So with that, thank you. I want to kind of end on a lighter note and just share with you a couple of quick catchphrases. I can see my time is up, so I'll be fairly quick here. And these are things that have hit the press in the past couple of months, yeah? Let's see if you know any of these, yeah? So I'll start by reading them out. If you do, just raise your hand. So the first one is, do you know what Weimar is? Weimar Plus? Ah, you do. Perfect. I'll come and explain in a second. Do you know Readiness 2030? Have you heard of that? Ah, perfect. Next Gen Europe? Ah, fantastic. And Safe Europe, Stronger Czechia. Okay, not many. So let me tell you what Weimar Plus is. So Weimar Plus, it's an expanded European alliance formed in 2025, in February. It builds upon the original Weimar Triangle that had France, Germany, and Poland. But today it includes the UK, Italy, and Spain. This coalition aims to assert European influence in global affairs, especially in response to the shifts in US policy regarding the Russian-Ukraine war. And you will hear more about this. Readiness 2030, I think you've heard about it, but very quickly, it's a strategic defense initiative proposed by the EU Commission. It's important because $800 billion going to enhance EU's military capabilities. Next Gen Europe talks about progress of investment in the future with green and digital transitions. And Safe Europe and Stronger Czechia emphasizes security strength within the European context. Now, let me share quick 4 economic buzzwords, which are very new, by the way. The first one, have you heard of greedflation? Okay, one person, fantastic. Shrinkflation? Wow, okay. Vibe session? 1, fantastic. 2, okay. And disinflation. All right, perfect. Okay, you guys are good readers. Okay, so greedflation, it's a term suggesting that corporate profit-taking behavior significantly contributes to inflation. It has gained traction amongst economists and policymakers discussing the causes of rising prices in Europe. Shrinkflation, the practice of reducing product size or quantity while maintaining the same price, effectively increasing the price per unit. This phenomena is observed across European markets. Vibe session, a term describing a situation where consumer sentiment is negative despite positive economic indicators, leading to reduced spending and economic slowdown. And lastly, disinflation, the slowing down of the rate of inflation, indicating the prices are still rising at a decreasing pace. So with that, thank you very much. Thanks for having me, and have a wonderful day. Yeah? Dziękuję. Excellent.
Thank you very much, Munir. Fantastic speech, and actually a lot more hopeful than I feared, since we live in times that sometimes can be a little bit depressing. And I think yesterday's sessions in some cases were quite pessimistic. We explored a lot of the problems, and luckily, at least a few solutions. And I think you are now setting us on course for exploring the solutions and the opportunities, actually. And, you know, as we discussed yesterday, change starts very slowly. You know that famous quote, you go bankrupt slowly and then very fast. So maybe we're seeing also that with some major changes across the board. I do like that you mentioned that resilience is the new super strength. What resilience looks like for Central Eastern Europe is a very good question. Yesterday we had the Deputy Minister Marek Mehra, who actually pointed out that capital markets are one of the most important things that we really should finally sort out in Europe. The fragmentation and variety of issues, we need much more retail investment, we need more listings in this country and others. We really need to energize the capital market. And on that note, I will introduce the next session, and I have the great pleasure to welcome back Mr. Petr Koblic. He's the CEO of Prague Stock Exchange. Please, to the stage. Thank you, Petr. Petr has been with us before, and his sessions usually are very popular. So I'm very pleased that you came, because your honesty and a good discussion, that's always very much appreciated. And then we also have the pleasure to welcome Mehra from Citibank, head of EMEA Sustainable Debt Capital Markets. Sanaa has been in Prague before, so we are very pleased that she's one of those international people that visits a little bit more frequently. And I have to mention that I was not supposed to chair this session, just to flag it. It was Mr. Tomáš Provaznik, but unfortunately he's fallen very ill. He sends his apologies, and hopefully we will hear from him next year. But with that, let's get started. Okay, so let's just dig straight in. I will start with Petr, since you're the local market participant. The omnibus keeps coming up. Every conversation, people are not only worried about the trade, the tariffs, etc., but it's also the EU competitiveness. So do you believe that the EU omnibus and the competitiveness shift will improve the capital market functioning in the EU? Do you believe that this is actually what we needed?
Well, what I should say, well, thank you very much for inviting me, actually. It's a great pleasure. What I should say, should I be optimistic? You said like...
you should be honest. That's the most important.
Oh, those are the two different things. But, right. Yes, at least there is some focus, I would say. That's very good, actually. And sometimes I feel that the focus is kind of distracted, you know, then there is some idea which appears to someone. We are usually thinking Brussels, but let's say in a commission, those are our employees, you know, we pay them as Europeans. So they sometimes bring some new ideas which they are very committed to and which they think is a great idea. And then we as the market participants and as the business professionals are telling them that's not really the right direction. So yeah, sometimes the discussions are difficult. I've been on a 5-hour call on Friday, and yes, I think there is a will to do something. However, I'm not 100% sure they are taking it from the right end. There are problems which are difficult to solve and which would be perfect to be solved. And then there are some which looks easy, but they are not easy, but they are not really helpful, and they want to start from this. And so, yes, it is a very difficult situation. We can speak hours about the kind of improving the European capital markets. They are definitely lagging. You know, at least we admit, you know, that the US is doing that much better, and that the capital markets in the US are doing that better. You know, we hear a lot of times in the European Union that we don't want to copy the US. Oh, well, what's wrong on that? You know, they really do it well for 100 years. And you know, there are difficult discussions, I would say, and no easy solutions. And yeah, we will have a long road ahead of us in order to streamline some of the things. Yeah.
Thank you. I mean, it did take us a long time to get even accounting right, so I guess we shouldn't also be unrealistic in our expectations.
My cheeky comment in Europe is sometimes, you know, when I'm coming to Brussels, I'm thinking, you know, I'm saying there, you are making a common Europe or united Europe for what, 70 years already, since 1955, basically, and why you don't have a common EU gap? You know, we still have 27 accounting systems. Okay, there is international accounting standards, but they are only for listed companies, but all the companies have to run the domestic standards in order to pay taxes. You know, in the US, they have a US gap. But it's like what I don't understand, why we don't have a EU gap. It would make so many things much easier, bond issuance, and okay, and then we can go to the bankruptcy law, resolution law, securities law, corporate law, and actually in the end is the civil courts, you know, which are different in different countries, which make, especially in the debt area, it's very complicated, but also on the equity area, we are quite far away. And we are trying to solve the technical things, but the key is to solve the accounting, reporting, and those kind of matters.
I couldn't agree more. We had a very difficult discussion recently in Brussels where we actually, together with some associations, pushed for the fact that sometimes it's the harder and things that kind of aren't trendy that need to be solved first, whether it's labor mobility, it's literally local bureaucracy, and accounting is one of them. But there's also other things that, you know, doing accounting in every single language across the EU is It's quite expensive, actually, for business. Let me turn now to you, Sanaa, just to bring you into the conversation. So, as a very active market participant and working on sustainable debt itself, and we had Sean Kiddy from Climate Bonds Initiative open, actually, this conference this year. And he gave us a big, hopeful message in terms of, the volumes are growing. Of course, what's under those numbers is a different thing. So we have a mixture of different types of debt, etc. So what developments have you noticed in the capital markets in the last 2 to 3 years? And also, just a question as a former EU Sustainable Finance Platform member, I'm actually curious, is the EU taxonomy been useful for setting at least some sort of gold standard for bonds and fixed income? And then I'll follow up with another question about greenium, but let's start with this.
Sure, thank you, and thank you for also having me here. I think in terms of, hopefully I'll continue with Sean. I'm sure he's very optimistic, and an optimistic note. The sustainable debt capital markets are now firmly an asset class on their own. There are about 5.2 trillion in outstanding sustainable debt at the moment. And actually, very positively, something Europe has done right is majority of issuance has come from Europe and from the Middle East and Africa. About 60% of that 5.2 trillion is from issuers within the region here. In terms of annual issuance volumes, we saw them peak in about 2021 at 1 trillion. Since then, it's fallen off the peaks, but we've seen about consistently 800 to 900 billion of sustainable debt issuance over the last couple of years. And it's also engaging all types of issuers in the market. I would say about 50% comes from public sector issuers like your Western European sovereigns, multinational development banks, the likes of World Bank, EIB. And then you have about 30% in corporates and about 20% from financial institutions. And what's also really interesting to see is there's a significant issuance from the Central Eastern European region as well. About 46 billion has been issued already, of which about in the Czech Republic is about 16 billion of issuance from the Czech Republic is the biggest piece. And then last year also saw record issuance in this from this region. So all different types of issuers really engaged. Sustainable bonds have been a really great tool for issuers to communicate their sustainability strategies, their transition plans with investors. They are able to have different types of conversations, not just about your credit performance, etc. That is, of course, very important, but also more forward-looking strategies. And some of the key trends that we've seen over the last couple of years and I'll go into it in a second, but EU GBS, the EU Green Bond Standard, the EU Taxonomy, there's also SFDR impacting investors. So it's making market participants a lot more cognizant about the sustainability claims that they're making. They need to be very careful. They need to be able to back those sustainability claims. Another topic in the market is transition finance. So it's not only about how do we put capital towards the greenest projects, but how do we work with companies and sovereigns in financing the hard-to-abate sectors, going from brown to less brown to green when the technology is available. And the third key thematic, I would say, is more thematic issuance as well. So we're seeing a lot of investors. They, of course, want to invest in the broader sustainability agenda, but they have asset owners who want to put capital towards very specific impact. So we're seeing the launch of, for example, gender bonds. Last year we saw a couple of blue bonds being issued as well. So that's use of proceeds going to finance projects for the sustainable blue economy. So being very, very specific in those themes as well. And that's kind of the overarching, the key themes that we're seeing. To your question about is the EU GBS and taxonomy creating a gold standard? I think it depends on how you define what is the gold standard. So if you're thinking about impact, it's not necessarily, an ICMA green bond can have the same amount or more amount of impact in terms of, say, greenhouse gas emissions saved as an EU GBS, because that really depends on the underlying project and the quantum of the project being financed. But what the EU taxonomy and the EU GBS has done is it's created standardized definitions of what is an environmentally impactful activity, what other criteria investors and issuers should be cognizant about. And it takes the guessing game away from investors and issuers. From an investor perspective, if they buy a transaction that is EU taxonomy aligned, they can feel confident of the sustainability claims. Same thing with issuers. And what we've seen, a lot of hard to abate issuers who probably not have engaged with the market before because they thought, we're not sure, is this aligned to the criteria? How do we show the impact of these projects? They can show that they're aligned to a taxonomy that is science-based, that is put together by industry experts. And then also the EU GBS is created a standardization in terms of documentation. ICMA green bonds come with green bond frameworks, which have become standardized over the course, but the EU GBS has taken it a step further with certain fact sheets and said, right, this is the information, and makes it easier for investors to find exactly where, what information they're looking for. But although the market is still very small, we've only seen around 5 bonds in EU GBS. We do expect a lot of issuers to potentially take that on.
Interesting. So now my question to essentially what's the upside, right? So I know that the Prague Stock Exchange did ESG guidelines a couple of years ago. So I actually want to ask, from your perspective, would you recommend companies to continue reporting, even let's say an SME that wants to do an IPO? Would you actually suggest that non-financial reporting is important to them? Will that make a tangible difference to potentially how they're going to fare during their IPO? So that's a question to you, Petr. And afterwards, Sanaa, do you expect a greenium for taxonomy bonds, for example?
Oh, I would love to hear this one.
We don't have much time, so let's...
Yeah, unfortunate answer is, yes, of course, they are looking for reporting. They have to do something of the reporting. Does it make a difference in the replacement and IPO? The answer is no. I never met an investor in CE who was a domestic investor, retail or domestic money, who care, really, an IPO. We witnessed that, and I was really, really angry. We witnessed that in one of the issues we had like 3 years ago, when there was an issue of the famous Czech weapons, like guns, producing company. Well, not the big war weapons, but the guns for the police and whatever, sport guns. They're actually sitting right next here. And there has been the Western European banks, especially from Netherlands and Belgium, who were prohibited even to speak about that with the client. So they were not placing that. The company later on bought the American competition. It's a great success story. Investors made a lot of the money, and I was really angry because, like, what is the problem with the ESG investment? To actually produce the guns for the police departments. So kind of. So I think it went
that
over. That
wouldn't have been ESG, and this is a common myth. It's not ESG; it's exclusion policy. It's a completely different thing.
Yeah, but they were claiming, that because of ESG they cannot invest and whatever. But the investors, retail investors and asset managers in Czech Republic, I never had a meeting with any investor who would be selecting their IPO investment based on the ESG so far. In a debt issuance, maybe it's a different story. We are just going to be launching in 2 or 3 weeks, actually, the green bond segment, because we afford enough green bonds, to make it a segment. So in debt investment, maybe there is a little bit different story. So, let's focus on that one. But on the equity side, I don't think, and that is really plays a role. So I would like to hear about the greenium.
Yeah.
How much it is, really. It's like
Before I go into the greenium, I think it's really interesting that you say that, but I think in international IPOs, ESG still does, and non-financial reporting does play a part. If you can position a company and add the ESG, not ESG, but the sustainability, the transition story, if you can build that into the company's proposition and positioning story, it does help. It does open up investments from sustainable pockets. So there are then potentially more pockets that you can get to. You can have a higher order book in your transaction, etc. So
Really? Did you ever heard a sentence? I don't like the valuation of the company, but because it's so green, I will buy it even if it's expensive.
no,
Exactly. Me as well.
But I think that
it's
exists also.
complementary. I'm not saying it's one or the other.
Okay.
It's
But it
definitely
exists
complementary.
in fixed income as well, right?
Yeah.
It's actually the credit rating of the issuer that is probably slightly more important.
Exactly.
And then the additionality
Might be a
comes
little
from
bit different
ESG.
with fixed income. Yeah.
So it does enhance execution,
Right. Okay.
but not necessarily will replace if the credit fundamentals or the IPO fundamentals don't work first. What's also interesting is that there was a Morningstar report that was published on sustainable fund flows earlier this year. And we saw that in Q1 2025, there was a majority outflows. There were headlines in sustainable funds, but that was mainly focused on equity funds. But we actually saw a record inflow into sustainable debt, fixed income funds. And that's because, I think to your point, that in equity, it tends to be exclusionary policies. So when you have sustainable funds, they're excluding massive amounts of different industries, and therefore you are less diverse and can potentially have the risk to underperform a benchmark more, versus in sustainable bonds, you have all different types of sectors that are issuing. The pricing is quite similar to a conventional bond, so it's less likely you're going to underperform in a sustainable fund versus a conventional. And then to your point on greeniums, it's, we always tell issuers that's not the main reason why you should issue one of these transactions. It's purely a supply-demand dynamic. In the start of the market, we saw a launch of sustainable funds, and the market for sustainable debt was quite small. So it's purely supply and demand caused a greenium of a couple of basis points. As the market in sustainable debt grew, we saw that erode. But this year, actually, we've seen, as issuance volumes have dipped a little bit, we have seen the return of the greenium again, purely because of the supply-demand dynamic. And then in terms of EU taxonomy specific or EU GBS specific transactions, again, they're quite rare. And what they offer investors, particularly in Europe, is if you buy an EU green bond standard aligned transaction, you get 100% of the use of proceeds are taxonomy aligned. It increases the taxonomy alignment of their overall fund. So at the moment, they're just tracking the alignment of their funds. They haven't set targets, but I think in the next coming years, they will be setting targets that, my sustainable fund has to be 30%, 40% EU taxonomy aligned. They will start preferring EU GB transactions. You might see more demand for those. That might cause a greenium in the future. So there is appetite for that, but that shouldn't be the primary reason why you want to do one of these.
I mean, it's interesting because everybody's asking about the greenium. Also, we've had so many companies that we talk to that are like, am I going to get any better deal from my bank if I'm doing...
Have you ever heard number?
Yeah, I have.
What is it, on the
But
5-year bond?
I'm not allowed to disclose it because it's very interesting. On the bonds, it's public information, so you can actually... There's a bunch of academics working on this. So there's a lot of disagreement whether there has been, hasn't been greenium, etc. But there is something happening, and it's probably supply-demand question here. But the interesting element that I found is... another element of green hushing from some of the banks that I was in a private conversation between a very big real estate developer and his banker. And the banker got very angry and was like, yes, okay, you are getting a better deal, but I can't tell you that because then I will have to start offering it to others, etc. And essentially a lot of the things that happen are decided internally and aren't necessarily broadcast because, they're internal policies that tell you how to essentially maybe tweak certain things, but it's very unlikely that you're going to try to pronounce that publicly because you might lose some clients. And at the end of the day, it's business. Anyway, thank you so much for listening. Thank you so much for joining. I know you're both super busy people, also with a very busy agenda. With this, we finish this part, and we will move on actually to a presentation from Gergely Pokos from OTP Bank. So thank you so much.
Thank you.
And on to the next part. So we're very excited actually to welcome OTP Bank back. Gergely will have a presentation. So OTP in Hungary has been known as one of the main players on sustainability. We have had also quite a few banks from across the region looking at their work. And also one of their representatives won the Sustainability in Banking Award yesterday. So we will pass that award on after this session. But over to you, Gergely. Thank you so much for joining us, and the stage is yours.
Good morning. Thank you very much for having me. And thank you, Linda, not only for the introduction, but for organizing such a great event. It's an honor to be here and a pleasure to participate, and especially to talk to you for a few minutes about what we believe banks can and cannot do for decarbonization. A lot of the presentations and the discussions over the past 2 days and also today have been in and around policy, so more of a top-down view of sustainability or sustainable finance. My presentation will focus more on the bottom-up view from a bank's perspective, and I will use OTP as an example, so our bank to deal with. But I strongly believe that if you look at other banks represented in this room or elsewhere, they will have similar experiences. It's a little bit hard to follow this conversation, by the way, about greenium. I do have strong views about it, but let's focus on the topic at hand and continue to discuss greenium over coffee. So first, I would like to just introduce OTP very briefly. Some of you may not be familiar with our bank. So we are a group of banks operating in 11 countries, mainly in the Balkan region, Eastern Europe, and quite recently also in Central Asia. We're a universal bank, so we offer everything. Obviously, that means that our clientele is somewhat different than what we heard from ING yesterday. So obviously, we have a lot of business in SMEs and a very strong focus on retail. We strive to be in a leading position in the countries where we operate, with a few exceptions. So that means that we basically finance a big chunk of the economy where we're active. This will be, I think, quite important as we go forward. Now, in terms of sustainable finance, this is basically what we're here to talk about. And I am responsible for sustainable finance, amongst others, for the OTP group. Our main objective, the main strategic goal of OTP in the sustainability field is to build the green loan portfolio. So finance as many green assets or green projects as possible. We are well on our way. End of last year, we had more than 2.5 billion euros in green assets on our books. And by end of this year, we plan to be close to 4 billion, quite well underway with this. In terms of what these represents, you can see the pie chart. It's no surprises, a lot of renewable energy projects, a lot of real estate, corporate real estate. On the retail side, we only do green mortgage. Electromobility picks up somewhat slower than expected. Most of our projects are actually not financing vehicles, but more in the electrification of municipal and state public transportation networks. But here it is. And the last point on transparency, we didn't put up the award that we won from Global Finance because we want to boast. Okay, not just because we want to boast, because we actually are quite proud of the achievement, but because we got the award for transparency. And transparency and honesty in reporting is something I want to address in my presentation today. When it comes to reporting on sustainability, or sustainability in general, we talk a lot about transparency. Most of the questions I get when I talk to investors or regulators, for that matter, is around the transparency of our reporting, how exact is it, and we talk very little about honesty. And I want to address this and show you a few examples of why this matters, what's the difference, and also now that CSRD is in place, and more banks report on what they consider their non-financial achievements in general, and then more specific around what they do for sustainability. How can we read those reports? How can we make sure that they're not only transparent but also honest, and how can we make sense of it? So obviously, it's a very simple pattern that we follow here. Traditionally, banks have been good at banking, right? And traditionally, banks have not been good at doing anything else. And there's so many examples around this, I don't even want to count them, but I think anyone who lived through the 2008 financial crisis and what happened afterwards, especially in this region with FX, residential loans and all this, does remember that banks usually not very good at managing complex socio-economic transformations. Now, I think we can all agree in this room that the question around climate change and sustainability is a very complex transformation, and it's not only economic, it's also impacts society deeply. So how can banks really interact in this field, and how can we position what banks do in a way that really makes sense? A lot of the times, if you listen to myself or my colleagues, again, I'm not pointing at other banks, only talking about OTP. Sometimes even when we communicate, we pretend that we really can move mountains around. And there's a lot of what banks can do and do for sustainability, but there's a limit to what we can do. So how can we track this in the reporting? How can we take the transparency that's in the reporting and get to something that is really honest and shows you how things progress? So as I promised, only talking about OTP. So if you read our reports, recently published about 2024, they did our climate target setting exercise. We chose as a baseline year 2023, and obviously there's a lot of detail behind it. I urge you all to go to the OTP website, download the full report and read it in detail. 750 pages of nothing but excitement. But a couple of outtakes. If you take all our financed emissions, okay, so the scope 1 and 2 emissions of our clients that we finance, here we only have the corporate part, but we also have the numbers for everything else. So you take all our financed emissions divided by our assets, you get to this 219 grams of CO2 equivalent greenhouse gas emissions per euro on our balance sheet. And this is the main target metric for European banks. You can also have it in absolute terms, but most of the banks who set targets set them in this field. It's also required by the methodology. Now, we also set a target for 2030, which means there's a reduction of 30% over this 5-year period. And as usual in these reports, there's pages and pages of disclaimers afterwards. So what does this mean? Is this ambitious? Is this not ambitious? What does it mean if we reach it? What does it mean if we don't reach it? Usually when we think about climate targets or decarbonizations, we think of a plan like on the right-hand side of the chart, that you plot out everything that will happen until 2050. You look at the end, is it net zero, yes or no? And if yes, are the actions there, is it detailed enough? Will you actually get there? I would like to put forward to you that this is not really the way to, or we propose that there's a different way to think about decarbonization plans and how you can actually manage that, because we believe it is dishonest to seriously believe that we can plot out everything that will happen in the economies where we are active until 2050. So what does this mean in practice? What can we actually do? What are we doing for sustainability and to manage the emissions that we are responsible for through the loans that we provide to our clients? First and foremost, we do a lot of green lending, and we will continue to do that. The majority of the business in green lending will be in energy vehicles, so transportation in general, and real estate. Some of it on the residential side for real estate, most of it on corporates. And by the way, there has been a lot of talk also in this room around access to finance and ease of access to finance. It is our experience that in the markets where we are active, there's much more money available than projects, good projects for that matter. So if you have a good project, if you have something that you want to build in this field, you will get very good financing. Banks are really competing for that, whether that's in real estate or energy or whatever. At least that's our experience. There can be other experiences out there. So we will continue to do this, and this will mean that the green loans on our balance sheet will increase. Now assets behind these green loans or the loan purpose themselves means that they have a lower emission rate than traditional loans or loans that finance high emitting sectors. So obviously that will improve what we do, and this will continue to be important. Now the second thing that banks can do and are doing, and we're also doing, is to put in restrictions on lending towards industries and segments that have high emissions. Now, obviously, the first and most important among these is anything related to coal, and a lot of European banks have put restrictions on themselves in terms of financing coal directly or indirectly. The effects of that you can all follow, but there are other hard to abate sectors, heavy industries, heavy chemicals. We talk much more about heavy industries than chemicals that have a lot of emissions, are actually very concentrated, but there's no real alternative to what they do, no real technological alternative, or not one that is economically feasible. Now, how do we deal with these segments? Restrictions to a level are fine, but if you have an industry in a country, especially a small country in Central Europe, where the national economy is depending on, and there's no real technological alternative yet to what they do, is it responsible for a bank to withdraw the funding and just say, this is someone else's problem and let them be financed by state actors or private equity, or actually stick with that client and try to finance energy efficiency improvement investments? Maybe they start a new venture and so on. We believe the latter is the way forward. So that's where our focus on transition finance comes from. That does not mean that we will finance everything over time. OTP also has put restrictions on financing anything related to coal, and over time there will come more and more. And last but not least, educating clients. I was very, very impressed with the presentation we heard from ING yesterday. And during the lunch break, I had a chance to talk to the Czech CEO about it, and they are really way ahead of what we do. There's a lot of ways to engage with clients and educate them. The example we put up here is on the residential side. So how we show our clients what their spending actually translates in terms of environmental impact. But this is much more about raising awareness than actually changing behavior. If you think in terms of corporate clients, it is, I think, unreasonable to expect, I would even go far to say dishonest to expect, that a bank, may that be as professional as banks can be, goes to a member of heavy industry and can tell them more about their technology than they already know. It is our experience that we don't need to raise awareness for the sustainability challenge in a cement producer or an aluminium foundry or something like this. That's not what they want. What they want is financing for the projects that they already have in their minds. And it is our duty to do that and to really calculate the environmental and financial benefits of that. Rather than to educate them. Educating, I think, is more about raising awareness, and we do that a lot. Now, So this is what we are doing, and you know, how can you track and measure the impact of what we're doing and what happens around us on our in our reporting? Because I also want to say that that what we do as a bank, and this is true for all banks, I believe, in Europe, is only a small part of what's really happening to the economy. Especially if you're a universal bank and you may be market leader in one economy or the other. So you're basically financing that economy. What you do is important and it has an impact, but you cannot decouple yourself from how the economy changes overall, how regulation changes, how events are shaping what's happening in the economy. So being able to track what's happening and what you can actually do about it, it does matter, we believe. So how can you track that change? Again, this is from our own report about 2024. Total GHG emissions in our financing. So for the ones keeping track, this is the category 15 scope 3 GHG emissions in our accounting, is 24.8 million tons of CO2 equivalent. Now, a very, very big chunk of that is actually calculated, not reported, but nevertheless, the methodology is sound and bulletproof, so to say. So, and this is quite similar for other banks again. So what are the things that we can influence and what are the things that may be beyond our influence? If you look at the composition, the simple composition of the total emissions, you can see that what we are maybe closer to influencing are the first three sectors: corporate business loans, real estate loans, and anything having to do with vehicles. Because there you can prefer green loans versus not green loans. You can restrict some of your activity. You can price. You can do a lot of things. Sovereign debt makes up a big chunk of our financed emissions, as it does for all banks. Now, it would be hard to imagine a European banking sector that does not have sovereign debt on their balance sheet. It's just the way banking works. So not too much we can do about it. We can track how that changes over time. If you read the national climate adaptation reports of any European country over time, you will also see that sometimes these reports are accurate, sometimes their predictions are accurate, sometimes they're not. And last but not least, a very big chunk of what we have on our balance sheet is actually scope 3. So this is the scope 3 emissions of the companies that we finance. This is removed to such a degree beyond our control that it's really hard to expect us doing anything about it. So our focus is on what we can influence and finance what we can there and restrict what we must, and the rest we track and try to influence policies. The other thing that we want to draw your attention to is look beyond the high-level numbers, look beyond the first line, think a little bit about the detail, because the accounting or the carbon accounting that is now evolving in Europe has a lot of finesse behind it, and understanding it is important, and it will deliver insights like this, which I think is quite a fairly straightforward one, but many people are sometimes surprised by it. Take the example of a flat, 50 square meter flat, one in Paris, one in Sofia. Exactly the same type, exactly the same emissions. From an environmental standpoint, exactly the same piece of real estate in Paris and in Sofia. These actually exist. Now, price difference is obviously huge. So the actual emissions behind the financing that you put there, if you compute it in relative terms, is a 4 times difference. So this actually means that the bank financing the real estate in Sofia has 4 times more dirty balance sheet than the one financing the real estate in Paris. Now this is just the way the accounting works. I'm not saying it's wrong. It's just something that has to be taken into account. You can plot this also in GDP terms, and then you can see that more dirty, so to say, economies are on the right side and the less dirty are on the left side. Now, a big part of this has to do with this whole purchasing power thing. Obviously, it also has to do with the Bulgarian energy sector being run a lot on coal, and that we can do about. That we can finance. There we can put money in place, and the industry actors can actually do about it, but we can hardly do anything about the purchasing power differences. So this is something to be taken into account and not to be taken lightly when you evaluate the performance. This doesn't only go for banks, by the way. If you compare utility companies across countries and across economies, it's the same story. So just something to keep in mind. And oh, my time is up. Sorry, I will try to finish very quickly. So the examples are a lot. I will not go through the next example. It's basically the same point. So fundamentally, what we want to say is that instead of expecting a bank, company, or anyone, or even a country for that matter, to lay out a perfectly harmonious plan all the way to 2050 until net zero, which we believe is not necessarily feasible. It is much more important to do constant monitoring over time, react to changes that you see, and really understand the drivers behind what's happening. Because at the end of the day, we believe it's much more important to focus on the things that you can influence and do what you can do there, because there's a lot we can do, as I believe I have shown you, and we are doing. That's not only for OTP, that's for the whole banking sector in the region. There's a lot also where we cannot work on alone. That's why we need policy, that's why we need associations, that's why we need governments. And we can also track that part on our reporting. We just want to ask everyone not to confuse the two with each other. Thank you very much for listening to me.
Thank you so much, Gergely. I think that was an excellent deep dive into what does it actually mean in practice and what are the limitations of what we're trying to do in practice. I think we've had quite an interesting morning with very different sessions and different focus areas. So I think it's actually great time now to have two people who have been working on sustainable finance for many, many years. And who are probably global thought, well, not probably, they are global thought leaders who are traveling the world, again, similar to Munir, and speaking to so many different stakeholder groups, so many different high-level people, etc., and often taking part in these closed-door conversations that maybe sometimes we don't really know about. So, in any case, it's my great pleasure to welcome Mark Campanale, the founder of Carbon Tracker Initiative. So if anybody has ever heard of stranded assets and carbon bubbles, it's actually Mark who invented the terms, promoted them, and if you haven't checked out Carbon Tracker Initiative, please do. It's incredible work. It also does a lot of analytics on different types of sectors in CE. And Professor Ben Caldecott. He is the founding director of Oxford Sustainable Finance Group at the University of Oxford, Smith School of Enterprise and the Environment. So Ben, again, and Mark are both of our advisory board members, so we're extremely grateful for all their support and advice over the years. And over to you. Thank you.
Over to us, Linda. I thought you were going to ask us some questions. Are we just supposed to chat? I haven't been briefed, clearly.
Let's just chat.
Okay.
Let's just chat. So that both of our work has looked at obviously the energy transition, the end of the fossil fuel system, and the build out of the new clean energy system. And we're both interested in what this means for global finance and also what it means for investors in the old system. Okay, which represents trillions of dollars of debt and equity value. So I think probably the first question is, we could ask things like, is the speed happening at the rate which is needed? And we're probably both going to agree that no, it's not. But what we could discover or just explore is the extent to which the end of the fossil fuel system would change how we think about things like asset write-downs, depreciation of fixed assets, and so on. So I'm interested in your views about do we think we've fully comprehensively understood the scale of the transition and what it will mean for this old system and how we build the new? So it's a sort of a scale question. Have we really penetrated all these kind of questions?
Yeah, well, I mean, I'd love your views on that too. I mean, I think we're at this point where, we've done, both of us and many other people here and hopefully watching have done a lot of work to try and understand the scale and pace of the transition, particularly a transition that's required to meet the aims of the Paris Agreement. And a lot of the analytics that Carbon Tracker has done and others have done allow us to understand the scale of those impacts, the distribution of those impacts, who will be affected when. And that's incredibly important. But I think those insights are going to also be helpful for understanding the massive transformation that is underway and will accelerate, that is adjacent to the energy transition, the climate transition, the net zero transition. I'm obviously talking about things like AI. And so I think one of the kind of the challenges and questions for us to grapple with is how do these things kind of fit together? How can we use the tools that we've developed to analyze those challenges? Because if we're going to think about and talk about asset stranding, climate is a massive thing, obviously, but there are these other drivers too that are going to kind of take it to another level.
Okay, so let's dig into the asset stranding. I mean, let's lay out the figures as I see it. So the last 200 years, we've built an industrial system, an energy system, a transport system, which is built on fossil fuels. I mean, that's just the reality of it. And it sits on top of the banking system with loans to operators, equity exposure, bond financing, and so on. So I think we both agree that we're going to have to disappear more than half of that over the next couple of decades, essentially, to have any chance of avoiding the worst of exceeding above a 2 degrees Celsius increase in global temperatures. Now, do we think the banks and the investors have properly priced this in as a pricing question? So let's say half of the global corporate bond market is linked to high carbon, so cement, steel, aviation, shipping, power and utilities, half of corporate bonds, okay? And I estimate around a quarter of global equity capital markets is exposed to high carbon. I just don't think the market has quite really understood what the write-downs will do. So let's put some figures on it. So we estimate that the value of the refineries, the value of the coal-fired power stations, the pipelines, the oil rigs, it's got to be around $35 trillion of fixed assets. And then if we think of the equity valuation of the fossil fuel industry, I estimate it today at around somewhere between 7 and 8 trillion of equity valuations, which actually in the scheme of things is not huge. And then if you think of the cash flows, the flows of the fossil fuel system, selling of oil, trading of oil and coal, that's probably another 20 trillion. So I mean, I'm interested in your views. Do you think the market is actually pricing this correctly today?
Well, I think there's sort of two issues. One is obviously markets are not pricing these things properly, and there's transition risks, there's physical risks, there are all the complexities. Many of you will be working in organizations trying to figure out how to measure and price these things and factor them into your decision making. It is difficult for some of these things. You don't have the projections, you don't have the data sets. We could spend a lot of time going through all the barriers that prevent the institutions from properly pricing and acting on these things. But I think, and a lot of people here would have read those studies which basically go, look, there's a carbon budget constraint, this is the scale of the asset stranding as a result. And I think the challenge we have today is that premise, which is central to this whole argument, or that particular version of the argument, doesn't hold anymore, I don't think, which is that the world isn't going to get its shit together and enforce a top-down 1.5 degree global carbon budget. It never was. So it's a starting point that allows you to do some analytics and derive some insights, but we're in a much more messy place. And so I think that's something, and it's a broader reflection on, I would say, the climate community, actually. A lot of the people working on this are very reluctant to talk openly about the fact that net zero 2050 is incredibly unlikely. And so, pricing, so yes, people having problem pricing things, but equally, factoring in global net zero by 2050 and making that the driver of a lot of your financial decisions, I don't think is probably the right decision for most financial institutions. I spent a lot of time in Asia, for example. I was just in Singapore. That's not how they get traction, because they just don't buy into that premise. And I think we're going to, it's not to say that we shouldn't have that conversation, but we need to have a variety of different starting points if we're going to bring different types of financial institution with us, I think. And that's a challenge for our community.
Okay, so I'm gonna take a slightly different tack on this, which is what are the signposts of a system that's ending? Okay, so we're going to replace all of the global power with electrification. It's going to be led by China. China is the first electro-state. They're doing it for geopolitical reasons as much as anything else. So the end of the petrodollar is going to be one of the key signposts of that. As China displaces fossil fuels, particularly in the global south, by exporting ultra-cheap EVs, ultra-cheap solar and wind. Okay, so I think that's happening. So we're replacing the old system with something that's new. That's going to kill oil demand, for clearly, and gas demand. What we've been studying at Carbon Tracker in the last couple of years, my colleagues Guy Prince, Harry Benham, and obviously we still lean heavily on the thinking of Kingsmill Bond, who's now over at Ember. So here are the signposts. So the oil and gas companies have stopped investing in replacing reserves. That's the first one. So if you look at the CapEx, instead of them using their cash flows to invest in new oil and gas exploration, that's been cut, and they've been doing share buybacks and increasing dividends. So we've mapped the curves, and what we can see in the last 5 years has been a dramatic collapse in new investment and exploration and expansion. Now, there's still too much going on, but that's the first signpost, I think, of the end of the system. And I think the way I see it, okay, the second signpost is reserves life. So the European majors, the large listed European oil and gas companies, are down to their last 7 to 8 years of reserves life. US, it's probably 14 to 15. And Goldman's, I think this is a really important study as a fact point. Goldman Sachs, about 18 months ago, published a study that said, since the stranded assets argument, with both you and I have talked about, the last decade came into being and made its way around the world of finance, the world's oil and gas reserves life has fallen from 50 years to 23 years. So those are the facts. And the fourth one to add is the closure of things like oil refineries. So Phillips Petroleum in Los Angeles just closed one of their largest oil refineries. They had a book value of 1.8 billion, or 1.3 billion rather, and they've written it down to 200 million, and they've had to put 200 million aside for decommissioning costs. So those are some of the signposts of the fossil fuel system wavering. So it's not growing anymore. It's not investing in expansion. They're cashing out as they self-liquidate, and they're starting to write down assets. So for me, that I am a bit of an optimist on this, and I think the reason for this is clear. The oil companies know the cost of building an internal combustion engine car is probably twice that of building an electric vehicle car. The operational costs are probably half. The maintenance costs are probably a third. Europe blew it. We spent a decade fighting legislation in Europe on fuel efficiency standards, and we gave 10 years to China to replace us with EVs, which they've done rather brilliantly, if we look at BYD versus any European manufacturer. So I'm quite an optimist that the Citi finance has woken up to the threat of stranded assets, and we can see this in the behaviors of the companies.
So I mean, maybe we're talking cross purposes, because obviously I don't disagree with most of that. Yes, the energy transition's underway. Yes, there are sectors of the global economy transitioning very quickly. And I thoroughly recommend you read any of Kingsmill Bond's work, who's excellent, who talks about these drivers and the inevitability.
And Doyne Farmer as well.
And Doyne Farmer, who's here, and lots of people you could read. But I guess the point I was making was that it's consistent to believe all that,
right,
and also for us not to to meet the aims of the Paris Agreement. And obviously, one of the big problems with the conversation we have is actually people get muddled up between net zero by a particular date and a 1.5 degree trajectory and temperature alignment and so on and so forth. And that results in a bit of a messy conversation. But I think when we bring it back to companies and also indeed countries, but let's go with companies, companies are not going to go any faster than they can based on the economics and the technology that's available. So we want companies to go as fast as they reasonably can, and you know, that's also the legal position because they have obligations to their employees and to their stakeholders and to their shareholders and so on. A company is not going to sign up to a Paris-aligned target and then achieve that target at the expense of being a profitable business. And that's friggin' obvious, but seems to have not, has not been internalized by a lot of people interacting with businesses and financial institutions. And our job is essentially to try and increase the speed at which companies can do this, but that means interventions in economics, markets, getting customers to want this stuff, but also in policy technology and so on. So I think I sort of see it in that way. We've got to up the speed limit. So essentially, you know, say a company is like a car and it's stuck in a traffic jam, you know, it's going at 10 miles an hour, you want it to get to 70. Well, how do you solve that? Well, the driver of the car can kind of maybe drive a bit better and maybe get up to 12 miles per hour, but there's some interventions there that the individual company can't make. They're going to have to be a whole bunch of investments and changes in how traffic's managed and so on and so forth to increase the speed limit for individual companies, but also for all companies. And I just worry that a lot of the things we talk about and work on don't accept that that's how we should be thinking about it.
I hear a bit of sort of the transition plan task force coming out in those comments. And I'm not going to disagree with the points that you're making. I'm looking at this slightly differently. So if you're looking at a company as an investor, obviously I was an analyst for 20 years or more before I set up Carbon Tracker. You're just going to do the basics. What are the key threats to a company? And obviously competition, the cheapness of its competitors versus what your products are some of the most important points, and the universality and the betterness of the product. A good example of this is the end of videos and Blockbuster and the rise of Netflix as just straightforward examples of this. So I think of technological innovation. So how fast is the competitors growing compared to what you're growing? And so we know that renewables is exponential growth in solar and wind, 20-30% per annum, as we heard from Doyne Pharma globally. And yet, if we look at the fossil fuel system and traditional cars, it's in negative growth. And so the system is changing. So the problem with that narrative is it clashes with the emissions reduction narrative. We ask companies to set targets to reduce emissions, when actually what we're really asking them to do is, are you going to survive this technological wave that's hitting you, particularly from the Far East with Chinese technologies, Taiwanese, Korean? Are you going to survive that? So we set these targets for companies saying, reduce your emissions, when actually what we're really saying is you're going to be competed out of business. With one exception, the energy system, we're divided into two parts really. We've got the producers of fossil fuels, which I think is the world that ends, and then the users of fossil fuels. So as an analyst, the question I would ask a high user of fossil fuels, particularly in energy and heat, power, is how much is it going to cost you to replace the system that you're in? And then the second question really is, can you afford it? And if we look at emissions reporting and all these, well, I'm not going to say task force, but all these net zero disclosure requirements and taxonomies, I think we've overcomplicated things when we've just got a very simple question to ask companies. And I think we're both agreed on this. How much is it going to cost you to replace what you're doing with something new? And are you going to survive in doing it? And are you going to be around? Because we may not be needing what you're doing right at the moment. But I don't see those basic, simple questions being asked too much. We frame it in carbon footprinting and emissions reporting, when actually what we really have to get companies to talk about is, do you survive being replaced by this new industrial revolution of clean technology, and tell us how you'll survive and we can afford it.
Taxonomize the hell out of everything.
We did.
And it doesn't generate any.
And it's biting us on the bum.
Yeah, but I also think this is a sort of, there's a bit of a philosophical difference between, rules-based approaches, principles-based approaches. And I think essentially what we're saying is, look, this is about corporate strategy, and companies need to respond to the signals. And the Transition Plan Task Force is all about that. It's about embedding kind of transition issues within corporate strategy. And hopefully, in time, it's so obvious that this should be part of corporate strategy that you don't need a kind of a task force to kind of explicitly signal that it should be.
Right, we've got 2 minutes left, and Linda, you're going to ask us the killer question that will force Ben and me to disagree on something.
Okay, no? Okay, now this one's on. I would actually like to bring it back to what Mr. Koblic said in the morning and the whole discussion about fixed income, etc. So the greenium issue has been ongoing forever. And this is really something that from communications perspective is very, very difficult, right? It's the same with banks. That they don't really want to say that they would give preferential treatment to those who are greening or actively investing in the transition, etc. So I know the principles have been very popular, and I agree that sometimes they're extremely helpful. And I think all of us in the audience can agree that maybe how the EU regulation was done, the sequencing and the complexity was too much too fast without any capacity to actually properly implement or without the stakeholders being ready to absorb. But then the question is, for years and years, the discussion was about greenwashing, about ESG funds having all sorts of collection of things like, doesn't make any sense. So you're investing in everything and nothing. And people confuse, right, ESG with impact. That's, I think, misconception and myth number one. Myth number two is, again, this exclusion policies versus ESG. So, ESG is driving away investment from the things that we really actually need, and it's going to harm the society, right? Security and defense, gas, because we need baseload capacity, etc. So we have all of these different types of myths. And I know that you do a lot of communication in different roles, etc. So actually, I would like to hear your thoughts. What can we do better around the comms about regulation? Because we are seeing a massive anti-regulation sentiment. And I was at a boardroom very recently where a big bank was so happy. The entire supervisory board was like, we're going to deregulate. This is a great outcome. And then somebody did a presentation on essentially how much harder it will be to collect the data, because now lots of things fall out of scope and they don't have to mandatorily do it. So my question to you, how do we actually communicate what good regulation looks like? How much of the regulation we need versus how much the voluntary things make sense? Because I'm sorry, but the voluntary stuff, I just don't think it worked either. So we're stuck between rock and a hard place, between voluntary and regulation, and we need to find some sort of medium there. So maybe we argued at the platform that what we need is 30 indicators for everyone, and that's it. No materiality assessment, so GHG emissions, water use, so some common sense things, and we should have maybe started with that.
Okay, first.
Oh gosh. Well, there's so much to unpack there. Look, I can't believe this, but I joined the Jupiter Ecology Fund in 1989, which makes this my 36th year of sustainable investing. And I've been bored to death for the last 30 years about definitions and standards and codes. I do support regulation, but I think explaining to people what you're doing and why you're doing it, transparency, is just as important as doubling or tripling your regulation. And I've not been a fan of the EU sustainable finance taxonomies. I think they've overcomplicated things. But I do think we need better regulation of marketplaces. And so in the UK, coming into maybe draft regulation in the next couple of months, a change to the prospectus regulation, which is a document companies use when they issue securities. There will be a new requirement for fossil fuel companies to explain why they believe that their new reserves, if they're developing new reserves, are consistent with the Paris Agreement. I mean, it's better regulation to me, but it's focused on transparency and explanation. So I see the same with, generally speaking, with anybody making green claims. I mean, okay, so I got to say, I don't wake up in the morning worrying about this issue. You asked about communications. The most important thing we've got to communicate is this clean energy system is cheaper and will be better and more reliable than the old system. And we've got to explain to people that this means lower prices in the pocket. Before I hand over to Ben, I just want to very briefly explain why. So, and it's an analogy I've used before, but it illustrates the point. When you buy a when you buy a printer for your computer, you're not literally buying a computer printer. You're buying a contract to buy printer ink for the next 10 years. They're selling you a ink contract for 30 years, okay? If you were offered a computer where you didn't need to buy printer ink and it was the same price, of course you would buy it, but they will never sell you that because they want to keep selling you printer ink. That's the same analogy with the fossil fuel system. You buy a car that needs a fuel or a power station that needs a fuel, and you're buying an endless contract to buy fuel. Now, the clean energy system changes that completely. You don't need a fuel because sunlight and wind are free. You buy your fixed equipment, may be expensive, but after that, it's free. So you get rid, and so the energy system halves. That's the interesting thing. And for the banks, now the banks are making money getting the stuff out of the ground through project finance. They're making the money by building the pipelines and leasing it back to you. They're making money by building refineries and giving you operating budgets. They're making money by giving you trading your oil and gas. Some of the biggest traders in the world have massive trading desks, Louis Dreyfus, Vitol, Glencore, the others. And then you borrow money from the bank to clean up the mess through decommissioning. Now, all of that goes from the banking system, which is why the banks want to protect the fossil fuel system, is because it's a revenue-making machine. So I'm the optimist that says, okay, once you've paid off the cost of your turbine, the marginal cost of energy drops towards zero. So energy costs will halve for the consumer and for industry, and the banking system hasn't woken up to this threat to its revenues and its profitabilities. Why do JP Morgan and the others love fossil fuel banking? It's because they're making money hand over fist through financing the trading of it. And that's the biggest revolution that we're going to see in our lifetimes, is the end of that system and a move to a clean energy system. Now, the taxonomies don't do a good job explaining something as simple as that. You know, that's why I don't spend my time thinking about taxonomies. I just want to focus on the message of why the energy revolution is going to improve people's lives, avoid catastrophic climate change, and lower people's bills. Those, to me, are the key communication points.
I mean, a lot to agree with there. I think, you know, a few things. When it comes down to policy and regulation, you know, you can't put lipstick on a pig. I mean, there's a lot of policy and regulation that is properly useless and counterproductive, and we should call it out for what it is. And I think there's sometimes, again, this speaks to kind of the community working on these issues. There's a reluctance to do that for a bunch of reasons, and I think that's unhelpful. In terms of the kind of greenwashing side of things, again, this goes back to principles versus rules-based. You know, it should be about being able to substantiate claims that you're making, and if you can't substantiate your claims, then there's going to be enforcement action. I don't know why that's so difficult. You know, that is the thing. And if we, you know, and it also, you know, the markets are innovating and they're coming up with new products and services, and so they're going to be trying to make new claims, and they're going to have to substantiate them, and you know, that's fine. We shouldn't be trying to lock in a kind of a series of products in a particular point in time. We want to encourage the market to innovate, and so that principles-based approach is absolutely key. And then in terms of communication, I mean, it depends on, who's the audience, who we're trying to communicate with. And I think, one of the things that was, been very powerful about the work we've all done on stranded assets is that, the reason for doing it was because risk is talking about risk is a great way of motivating financial institutions and financial regulators to think about these issues. And that's why in the course of, 12, 13 years now, 14 years, we've got to a stage where there wasn't a single person in the central bank working on climate change, to a point where there are hundreds of people working on these issues across central banks and financial regulators around the world. And that is actually such a massively important thing. But then in terms of the public, to Mark's point, we're going to need some more compelling stories, I think, and narratives. But these narratives need to be grounded in truth. And again, one thing about the climate community is that sometimes we kind of get detached from that a bit, and then certain things that are actually things we should be able to say become kind of sacrilegious, and you can't say them. And I think so. I have this sort of broader concern over the next 5 or so years, and looking at our country, the UK, and politics around climate change, that we're getting into a very unhelpful place, partly because the climate community isn't kind of moving with the changing facts. And that's going to be a big problem. But we could unpack that. It's a very interesting question. But yeah, I'll stop there.
Thanks, Linda.
Thank you. Thank you so much.
Thank you.
Thank you so much. That was absolutely fantastic. Exactly what we hoped for. I think that's a very interesting question about truth and communication, etc. We discussed yesterday at the comms roundtable with some people from the local TV stations and media, etc. So what is actually the truth, right? It depends on where you sit, and it depends on your view of the world. We should be trying to communicate scientific facts, but often the scientific community isn't involved enough in this discussion. And I do think that we need to recognize that sometimes people do have deep-seated ideological beliefs, and those sometimes we do need to challenge with facts and reason, etc. But the main underlying point is that we need to keep talking, and we need to have the spaces and the ability to do so, because once we get more siloed, well, then that doesn't bode very well for the future of economic growth. But on that note, just to quickly wrap up, we have one thing that we want to do before we go for the coffee break. So yesterday, Sylvia wasn't able to join us in person. So I would like to invite Sylvia Golia from OTP Bank to the stage, please. And also Petra Ondrushova from Česká spořitelna, CSO. And Sylvia yesterday won our CE Sustainable Banking Leader Award. And Petra said some very kind words and introduced the award. And we promised that we will hand it over to you the next day when we actually find you. So over to you, Petra.
Good morning, everyone. Well, Sylvia, I was honored last night, but we didn't meet to give you, this award for the sustainability leader in banking. And I know how hard and difficult the, sometimes is, because I am the sustainability chief officer at Česká, which is, the quite big bank in the Czech market. So I am very happy that you were recognized for all the effort you are doing, and I heard a lot what you've been, achieving in your path and what you started doing in OTP. So I wish you all the best and good luck for the next journey, and thank you that I can give you the award. And congratulations.
Thank you. It's an honor. Thank you. Thank you. It's an honor. I'm surprised, and I think it goes to the entire OTP team, so thank you.
Thank you. And now, coffee and food. You're free. See you at 11:05. Thank you.